Welcome to today's lesson, focusing on price action and how markets move. Pretty exciting topic today. The outline, little disclaimer, then we're going to focus on price action, market structure, structure on multiple time frames, and structure breaks and shifts. Little disclaimer, please proceed with caution when trading with actual live funds. Trading is very risky. Price action, one of our favorite topics. What does price action mean and how can you use it to your advantage? So price action is basically focusing on reading the charts candle by candle, rather than just relying on indicators or other concepts. Most experienced traders are price action traders. They read the chart candle by candle, and you do understand that any move within a trend can lead to a reaction. Indicators, on the other hand, they will lose their edge when the market isn't trending. They create all kinds of false signals and are not really reliable. Price action is more reliable. It is the key to becoming a successful trader. How does price action look on a live chart? And let's illustrate inside of TradingView the points that we're focusing on when actually using price action. We're back on the charts, looking at gold spot on a 1 hour chart. And let's look at a couple of things that from a price action perspective are important for us. We can see that the price is currently ranging in this area. So the points that we're trying to focus on are swing highs here and swing lows on the downside. So we're not relying on any indicators telling us that price might move in a certain direction. We are relying on what we're seeing in front of us. And in this current market condition, there is not really any trade from a professional perspective we can take. We might drill down on multiple time frames to find an entry, but this is basically what it means to look at a chart candle by candle. We're having a swing high here, the market moves down and it creates a swing low. By the way, little food for thought, what are swing highs and swing lows, and what makes them a swing high and a swing low, or a short-term high and a short-term low? When we're talking about a short-term high, we're basically referring to an up close candle here, a green candle going up, having one candle lower to the left and one candle lower to the right than the wick. So this is a swing point. The market draws down. We're having one candle higher to the left and another candle higher to the right. So it's a low swing point. Don't worry if it doesn't make sense right now. It will in the future as you're progressing and gaining more experience. Market structure, by far the most widely used concept around the world, and very professional traders are relying on market structure and price action in their daily activities. We are going to look at market structure in multiple time frames. We're going to identify what downtrends, uptrends, and ranges are. We are going to identify pivot points in the market. So price never moves in straight lines. It always moves in waves, of course. And these pivot points are being called swing lows and swing highs. Same thing we've just covered in our price action section. So without further ado, let's jump into the chart and let's look at market structure. All right, folks, we're back in the charts. And before we're actually looking at a live chart, I wanted to illustrate what market structure essentially means. There is three things the market can do. And remember, markets are moving in waves. The first thing the market can do is move to the upside. It can move to the downside, and it can move sideways within a so-called range, a ranging market, an uptrending market, and a downward trending market. These markets are being identified by so-called swing points. What's a swing point, you might ask? And let's look at this. Here, for example, we are having a low. We're moving to the upside and we're creating a high. Those are our swing points. That's a swing low and a swing high. We're creating another low here because that one's lower than that one, but it's higher than this here. So it's a higher low. We're moving up. We're creating a new higher swing point, and that one is being called a higher high. Now, if you see 2, 3 or more, you're likely in an uptrend. Now let's look at a downtrend. The same concept goes for a downtrend. You're starting from a high point here, from a swing high. You're moving lower, creating a low swing point. Moving back up, and this here being a lower high than that one, we're going to refer to that as a lower high. This low here being lower than this one, we're going to refer to it as a lower low. So we're moving from a high to a low, to a lower high, lower low. If you have a series of 2 or more of these, you are likely in a downtrend. These concepts happen on any time frame. And how that actually looks like, we're going to see in a second when we're viewing a live chart. Last but not least, the ranging market, the sideways market. It's an area where the price basically bounces between 2 levels, between the upside and the downside, creating equal swing points, almost equal swing points in a perfect world. Sometimes the price has the tendency to shoot a little bit to the upside and shoot below the downside and come back into a range. All right, folks, we're back in the chart and we're looking at a daily chart of an asset, and we've squashed the chart, making it very small, which on the other hand makes it easier for us to identify market structure. The less colors, the less wicks, the less noise. The only thing we can see now is market structure. And let's identify a couple of market structure points that are important for us. First of all, I'm going to use the pass tool and we're going to focus on uptrends. So let's say we're starting from down here, we're going up, and I'm not going to take all of the small ones into consideration, but rather the big swing points. We're moving down here, we're moving back up, we're moving down, we're moving up, we're moving down, and we're moving to the upside. Now I can see that I'm starting from a low point here. I'm making a high, a higher low, higher high, higher low, higher high, higher low, and a higher high until we're not anymore. The market decides to change something here. It's a great indication, by the way, but not our focus right now. The only thing that we need to concentrate on is to identify these swing points that the market is moving from one point to another, pulls back. And as you can see, you have a series of 2 or more higher highs and higher lows, which in this scenario creates an uptrend. Let's look at a downtrend. You've seen it already, that the price actually starts to create a low here. Now this low is lower than this swing point here, which indicates a reversal. Downtrending market structures consist of a high, lower highs, and lower lows. In our example here, how does it look like? We're having a high point here. We're moving down and we're creating a lower low, lower high, and lower lows. Why is looking at multiple time frames important? To the naked eye, on the daily chart, this might not look like a lot. It doesn't look like a nice market structure that we've been drawing earlier on. But let's try and focus on the very same area, and go on a different time frame, such as a 4-hour chart. This is the 4-hour chart of the very same price movement And we can clearly see that even within this move, we have a series of lower highs and lower lows. This is why it's very important to utilize multiple time frames to give you the best, most accurate picture. Let me go back to a daily chart right now. Give us all the price action back and let's continue. So we've just identified uptrends, downtrends. Let's look at a sideways market. Where can we find sideways market actually? Well, we're having one right here. The market tends to run in between these levels here until it decides to go higher and higher and higher. So obviously between these lows here and this upside, we're creating a range. And this is a ranging market or a sideways market. Some of you might have seen it already. We've just identified uptrends, downtrends, and sideways market, but there is more to it. If we're starting to look at these levels here, we can see the price bouncing between areas as well. And that's a ranging market in itself. Not only do we have one, but multiple ranging markets here. And that concludes our section on market structure. If you have any questions, reach out, and as a little homework for you guys, try to go back in your charts, utilize the pass tool, and try to identify market structure, uptrending markets by looking at higher highs and higher lows, downtrending markets focusing on lower highs and lower lows, and sideways market, an area where price is bouncing between certain levels. Now, back to our core slides. Let's re-emphasize what we've learned so far. Trending structures, strengths and follow-ups, uptrending markets, bullish structures, are identified by higher highs and higher lows. Downtrending market, bearish structures, are identified by lower highs and lower lows. You might wonder, breakouts from support and resistance with momentum bars. Every time we're moving to a new high, we're mostly breaking an old resistance point. And the candlestick patterns on each, the swing highs and the swing lows, are indicating reversals within a move. We're creating a higher high, we're having reversal bars in here. Creating a higher low, we're having reversal bars in here. So keep that in mind when backtesting and use it to your advantage. As an exercise, try to find candlestick patterns as the reversals are happening, either on the upside or the downside. Ranging structures, sideways markets again. Focus on rejection wicks. Whenever the market runs to one end of the range, look out for rejection wicks. It's alternating between bullish and bearish strengths. We've got bullish movement, bearish movement. Dojis and overlapping price action, watch out for that. Try to identify those patterns within your backtesting whenever price hits a support zone or hits a resistance zone within a range. Yeah? Look at the 20 period moving average. We are going to cover moving average later on. Yeah? For those of you more advanced, this is a great way to identify the moves within a trend. Yeah? Last but not least, again, dojis and overlapping price action. Altogether, candlestick patterns are important within any ranging market. Trending market, watch out for signs of reversal. Multiple time frames. Remember guys, we've covered this already, but try to use multiple time frames to your advantage. We've just looked at an example of a market in which it was difficult identifying a clear downtrending structure, as it looked like one continuous move to the downside. We were drilling down to a lower time frame to identify that we clearly had lower highs and lower lows within our downtrending structure. So make sure you add them to your favorites, add the different time frames to your favorites on MetaTrader and TradingView. Look inside of the candles, focus on reversals within the move, and see the patterns. Bear with us here. If we are repeating ourselves throughout the course, it is for your benefit. These are very, very important points to keep in mind. Multiple time frames are key to your success. Quick example again. This is the chart that we looked at a couple of moments ago. We see a steep drop in price, not really giving us a clear insight to whether or not this is a valid market structure. We shifted to a lower time frame. We can do like a 4-hour or a 1 hour. And what do we see? We clearly can see a series of lower highs and lower lows. This is a downtrend. Yeah? Please guys, keep that in mind. It's super, super important to switch between time frames. What you can see on a daily chart might look different on a 1-hour chart. With that being said, let's conclude today. See you guys in the next one. You have any questions, reach out to us. We're here for you.